You're cruising at top speed, the engine is humming perfectly, and then, without any warning from the dashboard, the tires completely lose traction. That sudden loss of control is exactly what many investors are feeling right now. For months, the SPMO ETF has been a massive winner in portfolios, but here in August 2026, severe cracks are beginning to show. On Wall Street, proprietary risk models for momentum strategies are currently identifying a spike in short-term exposure for anyone holding this specific ETF. Part of this pressure comes directly from the calendar. Historically, August and September are the weakest and most volatile months of the year for U.S. equities. This line chart plots that standard late summer market weakness, but look at the distinct marker appearing over the data. 2026 is a midterm election year. Political uncertainty historically forces major institutions into defensive postures, which can amplify that late summer volatility. This leaves you with a difficult choice. You have to figure out if you are sitting through a standard temporary market dip, or if the mechanics of the ETF have created a structural trap that requires an immediate exit. To make that call, we are going to look under the hood of SPMO. By running the fund through the same factor risk models used by Wall Street prime brokerages, we can separate retail investor panic from institutional reality. Surviving August requires looking past the ticker symbol on your screen and understanding the rigid, mechanical rules operating deep inside the engine of this fund. The basic promise of SPMO is highly appealing. It automatically scans the S&P 500 and buys the top 100 momentum stocks, letting you ride the strongest trends in the market. But right now, the money inside those 100 slots is not evenly distributed. This matrix visualizes SPMO's portfolio. Over 50% is packed into mega-cap tech and semiconductors, like NVIDIA and Broadcom. This heavy allocation drove massive outperformance, but it created factor crowding. Institutions are piled into these exact same trades. When those institutional players eventually decide to take their late summer profits and exit the trade, the massive volume of sell orders leads to a magnified drawdown for anyone in the crowd. The current political and macroeconomic environment often serves as the trigger for that exit. Investment banks are actively advising clients to lower their beta, their overall market risk, before the elections. As institutions pull back, capital flows out of tech and rotates into value and defensive plays like utilities. When that rotation happens, the capital outflow hits concentrated tech portfolios with punishing force. Factor crowding turns the ETF's greatest strength into a severe vulnerability. If tech stocks are dropping and defensive sectors are rising, the logical question is why a momentum ETF doesn't just sell the losers. The fund operates on a rigid schedule. SPMO's index rules dictate that it only rebalances its holdings twice a year, March and September. This flowchart tracks the biannual schedule. It's August, so the ETF is operating on 5-month-old spring data. This creates stale momentum. The ETF is trapped holding past winners losing steam today. It minimizes taxes but creates a late summer blind spot. The math of the index is completely inflexible. SPMO cannot automatically sell its bleeding tech holdings until the third Friday of September. August investors must absorb the unmitigated brunt of the tech rotation, while the ETF remains frozen. Ultimately, the fund's completely rigid biannual clock transforms an August market rotation into a totally unmanaged, terrifying freefall. Deciding how to react to this locked-in risk depends entirely on your specific time horizon. If you are a short-term tactical trader, your primary goal is avoiding severe, immediate portfolio drawdowns. For short-term operators, the risk-to-reward ratio heading into September is objectively poor. This is the period to trim your positions and protect your accumulated profits. This decision tree outlines the tactical pivot. Take cash off the table or rotate capital into an equal-weight S&P 500 ETF like RSP. By giving all 500 stocks the exact same weight, RSP mathematically strips out the tech concentration risk affecting SPMO. Rotating into RSP protects your capital during a tech squeeze, trading the possibility of a sudden tech rebound for immediate portfolio safety. The math changes if you are a strategic investor with a 3 to 5 year time horizon. The ETF requires time for its internal rebalancing cycle to catch up to shifting market leaders. As the decision tree shows the long-term path, the strategy shifts. On the third Friday of September, the rebalance automatically flushes out tech losers and buys new leaders. You endure short-term August volatility to capture the trend shift without triggering capital gains taxes. Holding through the storm requires enforcing the final universal institutional rule for SPMO. It is a satellite position, engineered to generate alpha. Because of its specific volatility profile, SPMO should only ever make up 5 to 10% of your total portfolio. It is too concentrated to serve as the foundational core of a retirement strategy. SPMO is a powerful engine for growth, but it only works if you align its rigid mechanical rules with your actual timeline and strictly manage your position size.